Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday to try to make sense of markets that really don't make any sense. And maybe today I should say to try to make sense of investors who really don't make any sense. You know, nobody rings a bell at the top of a market. It's a saying that, or the bottom. No one can time it. Nobody knows it. But if you ask people that are invested today, did you learn your lessons from the last two recessions? They'll say, I did. I'm not going to make the same mistake as I made last time. Yet today, the stock market is now more overvalued than it has ever been in history. Not on one metric, not on two, but on many. And what do investors do? They buy. You see, the problem with the stock market is greed kicks in. It's a very powerful emotion. And the answer is, well, it's going up. I'll sell when it's going down. Too late. When it does start to sell, there's no stopping it. And so when I say to try to make sense of investors who don't make any sense, I don't think people learned. And unfortunately, whatever day it comes that this market is going to unwind, a lot of people are going to go kicking and screaming. Because today I learned that 10% of the U.S. population owns 86% of all stocks now. You have one of the highest concentrations of wealth by the smallest number of people in history in an overvalued market. Do you know the last time we had a high concentration of wealth that brought the market down? It's 1929. So I want to talk this week about commercial industrial lending. And I didn't mean to be a little somber there with the beginning, or it's just people never learn. And for many boomers, it's going to come at the worst possible time of their life because there's no exit. But I wrote this week about commercial industrial lending. I'll put an addendum at the end for this week's data because I write everything about a week ahead. It just seems to work a little bit better for me. And one thing that is worth noting in the commercial industrial lending data, and why I find it so interesting, is because it tells us where there's inflation or not, because lending creates dollars into the economy. So when you're creating dollars, that's inflationary. When lending growth is flat or contracting, well, it's flat, it's not creating dollars. When it's contracting, it's destroying dollars. But based on the design of our monetary system, the dollars need to continue to expand. So you need to see lending growth continuously expand. And in the commercial industrial lending space, it's been negative on a 3-month basis for quite a long time, and has recently started becoming negative on a 6-month basis, meaning over the last 6 months, the amount of commercial loans is contracting. And then in the last 2 weeks, except this week, we saw 2 big drops. And then this week we saw a rebound, which would tell us that some defaulted loan came back. That's what it tells us. Because when I look at the underlying data, and I actually went back and looked at where the market bottoms were in the last 2 recessions and where commercial industrial lending was, and you do not start to see these large declines or these defaults until the stock market's already bottomed. Either 2 months before or the same month the stock market has bottomed. And at that time, in the last 2 recessions, you had the Fed massively easing with low interest rates and then quantitative easing during the great financial crisis. We have the Fed doing dollar loans, which is easing but not easing, and they're holding interest rates steady, and I suspect at the end of the month they will not lower interest rates. Meaning when commercial industrial lending does finally break down, which when it does was minus 1% on a 3-month basis, it's way too late. The Fed would need to be easing already, and they're not. So it's just not really. When I look at this data, people say, "Well, the economy is reflating." No, the stock market's reflating. The economy is not reflating. The stock market is not the economy, although people think it represents the economy. It doesn't. It represents speculative behavior of investors. Because if anybody who's invested in stocks bothered to look at the valuations of their stock based on earnings, they probably would sell. Or they'll just say, well, earnings don't matter. Well, you're right. Maybe they don't, because we're about to have 4 quarters of earning declines and rising stock prices. We have 5 years of declining profits and rising stock prices. The only issue will be is who will pay more than you? And at some point, there is nobody that will pay more. The economic data always comes true. It always points the right direction. The bond market always tells you the real story. The stock market is just running on an emotional sugar high, thanks to the Fed loaning money to the banks, where the hedge funds have been accessing it to bid stock prices up. It doesn't make a lot of sense, but when it unwinds, it's going to be a doozy. Now today, the housing starts brought Treasury yields up, and the Treasury yields went up at overnight trading, and then they went up again based on the housing starts, which is pretty interesting because most of the housing starts was based on multifamily or apartments. So what you're seeing is headline algorithms reading headline news and then trading on it. It doesn't make any sense because last I checked, people that rent do not have mortgages to do that. I just don't see it. Nevertheless, I want to come back to this the conversation we had about refinances early this week. So when I think about refinances and I think about housing starts, there's a couple things that come together. And a lot of people, they look at one set of data. You've got to start connecting the dots. Say, okay, well, this is happening, and then what's going on later this week or next week, and how does it all come together? Recently, we've seen in the Federal Reserve manufacturing survey data that new durable goods or new orders are ticking up a little bit. Today, the Michigan University of Michigan Consumer Confidence Survey said consumers are looking to buy more durable goods. And then when you look at the mortgage data, what do you see? You see an increase in new mortgages, not a huge one, but a nice increase. But it's like a 40, almost 50% increase in refinances. Now, what does that tell you when you think about refinancing and housing starts? So if somebody starts breaking ground on a house, how long does it take to get built? 3, 4 months, 6 tops. Now, if you refinance your house, are you going to move in 3 to 6 months? No. Why would you pay the refi cost and go through all the trouble to move? And don't tell me it's because you need a down payment, because if you have to refi to get a down payment, you're probably not qualified for the house anyways. So that doesn't make any sense. So what you're seeing is people that are not moving up. So builders have been extremely optimistic, breaking ground on new homes. And there's a huge surge in refinances, which tell us that people are looking like they're going to stay where they're put and take care of some things in their home that they need to. The other thing I've looked back in the data in 2008 and 9 was there was an increase in hours worked. Today we're seeing I'll never get it right, a decline in hours worked. So it also kind of gives me an indication, as I mentioned before, I think household finances are strapped. And I think some of this has to do with the trade war. Now, a lot of people are like, well, hasn't affected anything. Look, the Federal Reserve in their beige book this week came out and said, look, the tariffs have been absorbed largely by U.S. corporations and the rest of it by U.S. consumers. China's not paying it. They're not. That's not how tariffs work anyway. So the Federal Reserve is just telling us what we already know is to be true. But believe it or not, lots of companies import from China. Some of them are really small, mom and pop type companies, small, 1 to 20 employees. And I think they've been hurt really bad. And I think the reason you're seeing refinances is because where is their money right now? So if 10% of the people own 86% of the stock market, that means 90% own the bottom 14. I don't think you're going to go get a loan against, the 90% are not going to get a loan against their 14% of the stock market they own. I don't think that's going to happen. But housing prices are up. And I think people are using their house as an ATM like they did before the great financial crisis, but to help kind of deal with the shortfalls from the dollar liquidity crisis and the trade war. It's my hunch. It's just, we'll see. I don't know. But my guess is these companies, what I think people believed is the tariffs would go completely away. And they didn't. We know that. They're not going completely away. They got reduced, but they're not going away. And there's still some pretty hefty tariffs out there. Here's what I think people believe, but you're not going to hear anybody suggest this. I think people believe that this was just a big game between the U.S. and China. That the trade war wasn't really a real trade war. That it was just, we're trying to get something, they're trying to, keep the status quo. And at the end of the day, we were all just going to hug and pat ourselves on the back and be like, hey, we worked out our differences, it's all good. And that President Trump was going to announce a tariff refund. I think people believed something like that. Where, hey, this was on me, this was my trade war, we won it, things are going to be great now. And oh, by the way, if your company paid a tariff, fill out this form and we'll give it back to you. I think people believed stuff like that was going to happen. And it didn't. And businesses have been run down financially trying to stay afloat, and now they're turning to their house. Tough situation to be in. Okay, let's take a look at the M2 money supply. So the growth rate is rolling over and headed lower, flat at 7.09% roughly from last week, and the 6-month rate of change is flat, and the 3-month rate of change is falling. Now I want to look at where the details of this are. And here is the money stock measures, but look at institutional money funds. We're seeing money again flowing back into money markets. And when we look at that on a chart showing inverted here in blue, so this is money markets rising, but showing inverted, you can see that money markets kept interest rates, 10-year treasury yields here in check. But now that money markets are seeing an inflow, it's putting downward pressure on treasury yields. And you can see this recent move higher here, speculative move higher, is not validated because look, we were at these lows when money market funds were up here. So now there's money flowing back into cash flowing back into money markets, should continue to put downward pressure on interest rates. So I think that is something to come. Let's go back to the charts and see real estate loan growth flat at 3.9. Now we're seeing all these refis. That doesn't mean next week that's going to magically arrive in the data. You don't decide to refi today and get your money tomorrow. It can take several weeks. So we should expect to see a fairly sizable increase in real estate loan growth here, say over the next month or two as these refis happen. In the meantime, the growth rate is flat across the 12 and 6 month rate of change, and the 3-month rate of change is slowing. Again, not good. Commercial industrial lending, again, we had 2 months of 10 billion declines and we got 10 billion back. What I would interpret as a loan coming back out of default. So the growth rate on a year-over-year basis ticked back up to just under 1%. The 3-month rate of change rose, or 6-month and 3-month rate of change rose, which makes sense. But you can see this thing is flirting with going negative. When the 3-month rate of change goes negative, it usually goes to -1. It's usually too late. And the fact that it's been sitting here so long means there's virtually no growth in lending over the last 6 months. And what happens when you see that? You expect banks to lay off out of their lending department, which we're starting to see. Total loans and leases and bank credit, all commercial banks representing 1/3 of all loans in the economy. Growth rate is flat at 4%, which is not a healthy number. It's kind of on the lower end of, it's below the low end of prior cycles. The 6-month rate of change is flat, and the 3-month rate of change is at 0.65% and falling. This usually does not go negative until well after, the 3-month, 6-month, and 12 months don't go negative until well after recessions are over. So that's kind of interesting because credit card loan growth rates are rolling over. And let's go and look at the, oops for me, not for you, because you can't see me flipping back and forth. Here we go. Let's take a look at assets and liabilities in all commercial banks here. You can see commercial industrial lending jumped back 10 billion. Total loans and leases were up kind of 2 billion back above their peak from roughly this week in December. Commercial real estate up slightly, residential real estate up a small amount. So not a lot of big moves here. The big move was this loan coming back in commercial industrial lending. You can see 2.33, roughly 5 trillion, 2.344 trillion. There it is coming back. But this is still not anything to write home about in terms of, if you're looking at the bond market saying, is there reflation? Not here. There's no reflation in any of this. None. Maybe when those real estate loans come through, those refis, but remember, those refi loans should push 30-year Treasury yields down because the banks have to hedge that. There's another thing that I was thinking about, and I forgot what it... The Fed holds about 2/3 of all mortgage-backed securities, and they don't want to hold any of them. So think about this. All these refis are going to... How many of these refis are going to be for loans held by the Fed? Probably a fair chunk of them. We could just say 2/3 of them. How about that? That'd be safe to say, right? So 2/3 of those are going to get slotted over to the large commercial banks or to investors, probably large commercial banks. What are the banks going to have to do with those loans? They're going to have to hedge them. With what? Treasuries. You got it. Now, what's interesting to me is securities and bank credit actually fell $7 billion. They've actually reduced their Treasury bonds a bit. Now, I still believe that what's going on is they're loaning them to the Fed for cash, and at some point, these are all going to come back. And the reason I believe that is we're not seeing a massive sell-off in bonds. In fact, we're seeing bonds hold support and look like bond prices are going to kick off in a massive rally and Treasury yields are going to collapse. So this is somewhat misleading to what the market is telling us. Anyways, let's go back to the charts. Here we go. It's interesting. So I know some people said that, hey, this guy's stuff is not professional. I don't edit. This is real. There's no editing. There's no what. If I say something wrong, I'm not cutting it out. This is the real deal. I'm not putting this on YouTube to make money. I don't, none of that happens. I don't advertise on it. I don't make money from it. I don't even solicit for ads, nothing. This is just me and what I think of what's going on. Looking at S&P 500 buybacks, billions of dollars annualized, we're seeing the corporate share buybacks are slowing. And when they start to slow, that usually means stock prices go down. We haven't seen that yet, but that's usually what it suggests. And we can see that. I guess I don't have another one of those charts. Here's the S&P 500 price to sales ratio, all-time high. That means investors are willing to pay a record price for a unit of sales. That's a lot. This chart, I don't know who posted it, but it was based on TLT. So it's a fund that we're invested in and can be part of the portfolio shield strategy. So this person said that Treasury bonds are in a bullish channel, and he notates that this is an inverse head and shoulders within a purple falling wedge, and saying that bond prices are set to rise or interest rates are headed lower. Now we can't see the top of this, but Northman Trader put together a similar one and said, look, here we are in a wedge pattern and looking to break out to the upside. And that puts price target somewhere up in here in the 200 per share range, which is about a 40% upside return, which is right and consistent with what my projections are, putting the 10-year Treasury yield negative and the 30-year Treasury yield slightly below 1. And this week, we saw $1 billion of inflows to TLT on Tuesday. Isn't that interesting? So investors came in huge amount of buying on Tuesday. Looking at the trade balance with China, good news for the trade war, bad news for world dollar liquidity as the amount of trade with China decreases. So we should be running a surplus so we can get them more dollars so they can buy more treasuries and keep world dollar liquidity rolling, but we don't see it there. This is what's going to be a problem when the market goes down. The 5 largest S&P stocks as a percentage of total S&P market cap are now at their highest ever, meaning the 5 largest stocks represent 17.3% of the index. So when the market goes down and people sell, not only does everybody own the same 5 stocks, they're all going to be selling the same 5 stocks. And that's how bear markets go straight down. And here's the latest chart on the price to sales ratio sitting up at the top. And I think that's it for that. We'll leave the disclosure page there for future reference when we're done. Last thing I want to look at we got a couple more. Yeah, I want to look at this chart and then we'll get into the other things. This is the major foreign holders of U.S. Treasury securities. You can find this at tickdata.treasury.gov. It's published once a month. And what it shows us is a grand total of Treasury securities held by foreign investors fell $40 billion. From a world dollar liquidity perspective, the Fed is going to have to rescue the global economy. They're going to have to ease at a level never seen before in history and get interest rates down to zero and drive them negative. Because foreign investors, which is mainly foreign central banks, are short dollars. So how do they get dollars when they're short dollars? They sell. They're not selling to drive interest rates up. They're selling because they need dollars. Now, then what the market thinks is, oh, hey, look, foreign investors are selling, so interest rates need to go up. It's not how it works. What this is saying is the global economy is contracting. The dollar should be rising. And if it isn't yet, it will be. Because there's a demand for dollars, and these various nations are selling U.S. Treasury securities to get dollars. Meaning the U.S. Banks, U.S. investors, and the Federal Reserve are having to pick up the shortfall on top of all the debt being issued. That is not inflationary. It's quite the opposite. Deflation. It's deflationary. Almost over all that coughing stuff. Hallelujah. All right, so let's take a look at, I want to spend some time on gold if we have a chance. Let's take a look at 10-year Treasury yields. Now, technical analysis are pegging 1.7% as the break. So when that breaks, we're headed back down to the lows. And so today we held the 50-day moving average. And this is important because up here is resistance, down here is support. And so when you hit resistance and you can't get back through it, the next destination is to revisit support. And if it breaks support at 1.7, it's got to move much lower to 1.4, retest the all-time lows. Now, that's great news, is when you zoom out on 10-year treasuries, you have a triple bottom. And I've talked about this before, but you can go back to any book on technical analysis, especially the older ones that were written following the Great Depression, where the markets were not traded by computer algorithms. And they will tell you the triple bottoms are rare because quadruple bottoms are non-existent. I looked it up. Quadruple bottoms pretty much doesn't talk about it because the fourth time yields knock on the door, they break through. This is the largest topping pattern in 10-year treasury yields in history, which suggests that the smart money has been buying bonds all the way since 2012 because they know the economy is not that strong. Again, we have the highest stock prices in history. Think about this. Stock prices are the highest in history and the weakest growth of any economic cycle. Any economic cycle in the history of our country. Does that make sense? Well, the smart money knows that too. And that's why I put in the header of my update this week that when treasury yields go negative, 10 years, you're talking on something like TLT, we're doing a 30 and 40% return. On zero coupons, 50, because that'll drive 30-year yields down to 1 or slightly below 1. Now, where can you get that kind of return and collect a dividend check along the way? And when it happens, it'll happen fast. It'll happen within usually 4 to 6 weeks, but maybe as long as 3 months, but it'll happen real quick and it'll yank the stock market down. But here you can see the largest topping pattern in the history of 10-year treasury yields is right here. So when we break 1.7, we should see some selling down to 1.4. And at that point, it should break through. And anyone owning bonds is going to look like a genius because the last few years they haven't, but they will have their day. and everyone's going to wonder how they look so smart. 30-year Treasuries actually did close below the 50-day moving average. You see here, it doesn't show it on my chart because this thing closes out 30 minutes early. I don't know why, but it always has. But it did close below. And when you get a move through the 50-day, usually, and it reconfirms it on the bottom side in the case of this, it suggests that a move lower is in the cards. So for 30-year yields, you're watching 2.2 as the break to get down to the all-time lows. In terms of where it's at, you can see it's already kind of pointing down. You see, if with 10 years, we had the same spot at, say, roughly 2.1. Here we have it down to 1.9. But nevertheless, you can see massive topping pattern going all the way back to 2012. Just a matter of time before this breaks down. What will trigger it? I don't know. If we look at TLT, since we've been talking about it, here's that wedge pattern. If we zoom out, you can see it here, but we'll zoom back in. And what happens when you break out of a triangle pattern to the upside is not unusual for it to come back down and reconfirm the hypotenuse. Not unusual at all. Now, TLT did not close over its 50-day moving average, but I suspect it will going into next week. This is just telling us that there's no appetite. Because look, it went down and had buyers came in late trading. We could see in late afternoon, buyers came and brought prices up, and apparently in after hours, they brought them up over the 50-day moving average. I doubt that'll hold, but nevertheless, it might. And what this is telling you is squeezing all these people that have been short down below, suggesting the prices are set to go higher. Again, I think this thing's going close to, say, 200 or thereabouts. And part of the reason for that is virtually nobody owns bonds. I mean, I think the other day we went through and looked at the different, strategies that are out there, from quant models to hedge funds. Nobody owns bonds, and those that do are very few and far between. And a lot of those that don't are short bonds, like pension funds are massively short the bond market. So when the bond market breaks out, all these people are going to have to come in and buy. It's going to shoot this thing up like a rocket and shoot stocks straight down. What else do I want to look at before we talk about gold? Ag commodities, which are quietly coiling here into a triangle pattern. You see they crossed the 50-day moving average, reconfirmed it, and a triangle pattern after a bottom is normally a continuation pattern suggesting that ag commodity prices are headed higher, even though people are saying soybean planting season is coming soon. Don't worry. The market is telling us prices are headed higher here. Let's take a look at the dollar, since we mentioned the dollar, and we'll zoom out to the 2-year chart. The dollar is finding back towards its close over its 50-day moving average, looking at its 200-day, but in dollar liquidity shortages, the dollar should be rising. I suspect this thing will get over 100 at some point, and that will really put the hurt on corporate profits, but also on gold. Now, I want to look at gold for a second. And we see gold futures here tried to break out over 1,600, got rejected. There's a lot of support right around 1,500 here. But when I look at, because everyone knows that, Steve, you're super bullish about gold, but you didn't buy it. Yep, I know. Oops, there's a chart. Because this entire move higher in gold was pretty much borne by speculators. If you look down here and look at how the speculators moved the market, all this is speculative. So the smart money is deeply short gold, knowing there's a dollar shortage. So why is people like, the smart money is going to get shorted out of this? Well, look, who is a smart money? They're producers. So these gold producers, some people say it's all of the banks. It's a lot of these producers say, look, I'm happy to sell at this price. I'm happy to sell it to you. I'll sell all you want at this price, because I think prices are headed lower. I'm not worried about prices going higher. I'm worried about prices coming down, because if gold prices go higher, I'll just sell it to you at that price. If gold prices go lower, you've obligated to pay this price. Because producers, it's expensive to produce gold. So they're trying to hedge a downside move in price. But this whole upside move is based on speculators. And if we go back and look at the gold miners, which did not have the strong reaction, there's these gap. Maybe a small one right in here. There's these price gaps. So look, it came up and hit resistance. Came back up into the bottom of resistance. What does it tell you? It's likely to come right back down here, maybe a little lower, that would be the time to go because the dollar will be really strong. And then what happens? The Fed has to ease so much to get lending restarted because lending is going to blow apart. And they're going to have to ease a lot to get the banks to lend, to get these loans back out of default when this all unwinds. That's when you want to buy gold, not now. I think this is going to unwind. My opinion. We'll see. Obviously, you're not watching this because I'm the foremost expert on anything, because nobody in the market is a foremost expert on anything. Let's take a look at Boeing, because Boeing's got a massive topping pattern. Now, you've heard in the news, you'll hear in the news today, there's a little software glitch with the 737 MAX. There's more than that, but that is today's glitch. And there are some military planes that Boeing's built that they don't work. So the military is not happy. This is a topping pattern. So what it says is that people have been buying around 300. Whoops, did not mean to do that. Right, have been buying around $320 a share. So you see buyers. Some of them are up here at 340, but there's a lot of them down here at 320. And so what you're seeing here, now this line is not perfectly drawn. I'm not the best technical analyst out there. There are other people that do a much better job, but this is more for you to get an idea, is when prices break below 320, people that bought in these upper areas will likely turn into sellers. And speculators who like to short the market will come in and try to force this out. But what you're seeing is a 2-year pattern, because if we go to the 2-year chart, a 2-year pattern of probably the executives selling their stock. And what you're seeing here is it comes down to support and there's buyers, but the next rally is less and less buying enthusiasm. So buyers are running out of money, and when they run out of money, prices fall. Now, how far can this thing go? Well, oddly, there's an open gap right here, right around just above 200. And that's interesting. So it tells us that Boeing shares have a long way to go because we've never been in a market. Let me look at Boeing. I'll go out the max I've got. You've never seen a chart pattern like this. You've seen it go up and come down. We've never seen this thing flip over. So what is it? Why am I spending some time over Boeing? Do I have a beef with Boeing? No, I actually do generally prefer to fly their planes, although I'm not sure about the MAX. But for the moment, I generally prefer to fly their planes. I like them. It's when this breaks, it could send the whole market spiraling down. How far it can go, I don't know. But you look at stocks like ExxonMobil, which is one of the most widely owned stocks in the market, that has a 12-year topping pattern going back to 2006. You can see it here. When it gets down to 65 to 66 and breaks, all this is just going to be people that have bought in here that are going to turn into sellers. So you can see lower highs. The buyers are running out of steam, and so is this market, despite the fact that 5 companies are driving it to all-time highs. And I think on Monday, because the markets are closed, we should have all the data for how the hedge funds are positioned. So we'll do that. But I'm thinking about doing an oil special and kind of digging deep into the supply and where everything's at, because I'm pretty bearish on oil. Not that I'm taking a position. In fact, you could take it this way. If you're bearish on oil and you're not a speculator who shorts or does things like that, you're long bonds. So people say, well, interest rates are going to go up. Well, wait till oil goes down, because oil is one of the biggest contributors to interest rates, right? Because when oil demand goes up, it gets into products. Prices of oil goes up, it gets into products that we buy, gasoline and all that stuff. It gets passed on to the consumer. What happens if oil gets chopped in half in price or more? What's that going to mean for interest rates? They're going to go down, help shoot bond prices higher. So I think on Monday we'll do that. In the meantime, I'm Steve Van Metre. Thanks for taking the time to watch. The content of this video provides educational information only. Is not intended to provide investment or other advice. It is not to be construed as recommendation or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I'm on do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.